Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The rise of the market in late April, up through all the moving averages, as well up through some considerable congestion between September to November last year and again in mid-January to mid-February this year. This was the final creation of the early February to late April reverse head and shoulders bottom that gave us the move higher in the first place. Now, if you wanted to pick a date, then the 23rd of April, with a clear close over the dark blue neckline currently at 579, that was the day. By the way, please remember that dark blue neckline as it will feature again in more recent action. Okay, so the rise moved up swiftly and achieved its primary target at 635 and its hard to reach secondary target at 655. In reality, the market blew through overhead resistances pretty easily. It was only at the March 2014 high at 725 where we started to see the slowing of the aggressive move higher, peaking at the January 2022 low at 739 4 weeks ago. In the process of moving higher, the market created late April into May very steep and very acute purple highlighted bull channel. This has become somewhat of a bullish expanding wedge pattern. I said about this pattern 4 weeks ago, and I quote, "This bullish pattern will run this market until something comes along, something suitable to challenge it," and I think it might have spotted it something that just may do that. I had to go back to my longer term charts to find it, but just up ahead is the neckline extension to the big yet very thin head and shoulders top from the big moves of 20 to 21 to 23, and that's currently at 756. I suspect as we approach this neckline we may see some trepidation and possible anxious and apprehensive behaviour. I know I would be if I was approaching it." End of quote. The market's approach during mid-May to this neckline caused enough of a situation to occur that prices exited by effectively just going sideways, out of the purple highlighted expanding wedge pattern and down through the very steep uptrend. 3 weeks ago, and to a lesser extent 2 weeks ago, prices plunged lower. I said the following in my commentary 2 weeks ago, and I quote, "Now, I would draw your attention to one small pattern formed from Friday last week to date." So that's 3 Fridays ago through to about 2 Fridays ago. Small descending triangle highlighted but very lightly in pink on my daily chart. As if I made it any stronger, it would obliterate the pattern. We're on the edge of breaking lower from this pattern, which would give such a pattern good. End of quote, basically. Well, last week saw a true break lower from this pattern, reaching both primary and secondary targets within the same week. In the process, prices punched down through and closed below the July 2021 low at 609 and the March 2021 low at 592, plus the combination of the mauve highlighted medium moving average, currently 604, and the gold highlighted long moving average, currently 606. By the way, these two moving averages have not made a golden cross. The drop has been beyond that same old dark blue reverse head and shoulders bottom neckline mentioned earlier, currently at 579, and the December 2020 low, but within the congestion created by the reverse head and shoulders pattern between February and April. This is what I said last week when prices were down here, and I quote, "This is what we are testing right now. Should this give way, then the next support is the December 2020 low at 566, and I suspect that we might just see a slowing down towards there as the congestion throughout mid-February to late April starts kicking in at under 588 and goes all the way down to at least 545. So watch out for potentially some slowing from now onwards. This will also tie in with the idea of us looking at that small pink descending triangle as a possible halfway hesitation on the way down." End of quote. So I've seen the slowing down, but what's next? Well, Tuesday to Thursday this week inclusive, made a 3-day bullish morning star pattern, which today has seen, at least at the start, some resultant move higher. And they haven't even talked about heading up to test. The market hasn't even talked about testing up to the medium and long moving average combination overhead. I suspect we may see some consolidation, though a reactionary attempt higher to the medium and long moving average would fit in with that consolidation idea. Chicago corn. The medium moving average, currently at 449, had been a effective cap on the market throughout 2023, and once again capping rises in late March and April, but in early May it was breached and effectively turned into support. Prices went on higher through May to tackle the bright red highlighted extension to the lower trend line, currently at 467, of the July 2023 to January this year descending triangle, as well as the long moving average, currently at 466, and continued tackling those two for most of May. In the overall course of the move high, allowed me the opportunity to draw a late February to mid-April bullish shift pitchfork. Even as I was composing my words for this pattern 4 weeks ago, the lower time was under bearish pressure. Prices closing not only below the lower time, but also the short medium moving average, currently 454. 3 weeks ago, prices pushed below the next significant support, the Mo highlighted medium moving average, currently 447. The reason for this move low was because of the small double top formed throughout May. In reaching down to the medium moving average, the market also reached its primary and hardest to reach secondary targets, as well as making a weekly key reversal down 4 weeks ago. I said about the move below the medium moving average back 4 weeks ago that it was, and I quote, a significant level, as it was the doorway to the main congestion between 440 to 450. That is the essence of the big February to date halfway hesitation in the first place. So you see there's a lot below the lower time, and I'm not sure the market can take it on as yet. End of quote. I added 3 weeks ago, and I quote, that is why we have seen a reversal back up yesterday, so that Thursday 3 weeks ago. So we've seen a reversal back up yesterday with an immediate countering bullish engulfing pattern and a key reversal up, if only just on the latter. So what now? Well, there's a possibility the market may now use the lower time as a rolling cap on the market and run along the underside of this. I'm not sure it has the strength as yet to push higher over the bright red neckline or the long moving average overhead, nor as yet the strength to take on the previously mentioned 440 to 450 congestion below. So we might well be looking at a wide 440 to 450 on the bottom, up to 465, 470 range on top, possibly a market moving along the broken lower time. End of quote. And that is exactly what happened 2 weeks ago. The lower time highlighted for this point here in pink on my daily chart was the overhead resistance, whilst below we had the new very short pink highlighted uptrend that became the immediate support. What is more, these two trend lines combined made a small ascending wedge pattern. I said 2 weeks ago, and I quote, I can't give an idea of the direction yet, but the market will break, nor the direction the market will break, nor the proper size of the move, but I suspect the move right now may be lower. And I can, if prices broke through today, I can give an idea of the size of the move. Thus, a confirmed break lower, we would have a primary move of 6.5 cents, secondary move of 20 cents, end of quote. Well, by Tuesday last week, we had that confirmation. What is more, both the primary and the secondary targets for this small ascending wedge pattern were also quickly achieved. And we have seen an extension lower down through the November 2020 high and was a significant low throughout late March and April at 439, down to the 50% absolute Fibonacci line, where the market has hesitated, if barely. Now, looking back, one can see that the small ascending wedge pattern formed over June was also a bear flag pattern formed since the end of May. I asked about the future last week, and I quote, so what happens now? Well, I'm not sure, but it would not surprise me to see prices now start to slow around the 439 level. But all this action does prompt a question, a significant question. Is the action since late May a possible bear flag with potential down to the approximately 433 level, or is it part of a larger whole of 2024 double bottom pattern with potential down to the February this year lows around 414 and the December 2020 lows about 414, both 414, end of quote. Now, these were my immediate questions and thoughts about what may be happening right now, but today's action, you see, is a massive key reversal down at the moment below the low of February, and I'd be very interested to see where we close tonight. The only thing that's held it up at the moment is there's two pieces of congestion, but notably the November 2020 low, which is down at 397. That's stopping the market at the moment. But if whether we close over or under 408 will be very, very interesting, because if we do close above it, then the downside underneath that could be seen as a potential excessive spike. And then if there is any potential build-up, a reaction back up, which usually happens after such a big move, then one could look and say, aha, maybe this whole action from October last year until now is becoming a huge double bottom. But it's still too early to say on that, and it very much depends where we close tonight and the next couple of days or so. So watch out. Kansas City wheat. My apologies for some of the labels being highlighted in bright red on my daily chart. Sometimes my charting system throws a wobbler and does this sort of thing unintentionally. So please note there is no special meaning in any of the labels being highlighted in bright red. Okay, so late last year we saw the development of a descending triangle from late November 2023 to mid-February 2024, highlighted in purple on my daily chart. 15 weeks ago we had an attempted breakout below, but prices hesitated, then continued to hesitate, such that what initially thought might be a triple or quad bottom eventually became a quintuple bottom and also a rectangle pattern. On the 22nd of April, yes, I can actually narrow it down to a single day, we saw the first significant breakout of this rectangle pattern on the upside, piercing and then the next day closing over the mauve highlighted medium moving average, that's currently at 618, which had run in parallel and just above the purple highlighted upper trend line, and then later the lower trend line of the same descending triangle. The move high accelerated through some significant resistances and opted to form a bull channel. All this is well and good, but what lay ahead for the market? Well, I said 4 weeks ago, and I quote, we do have some serious overhead resistance. This is not obvious on my daily chart, but back between January to August 2023, the market formed a huge inverted roof pattern that played out nicely thereafter. We start entering the apex of the inverted roof pattern from about 740, but it will take a little while to truly venture into it, so caution. End of quote. That caution proved to be valid, as the overhang from the inverted roof pattern from the big pattern from last year really pressured this market back down, such that 3 weeks ago prices broke down through the big 50% Fibonacci line of the 2011-2019 move at 691, and 2 weeks ago punched down through and closed below the combination of the January 2015 high at 646, the long moving average currently 635, and the short medium moving average currently 651. As I said 2 weeks ago, and I quote, today's significant close below all these now sets into the frame the combination below the flatlining medium moving average, currently 618, the interesting 38.2% Fibonacci, and the big old 2011-2019 move at 618 as well. This is the next zone to watch below, and if that goes well, we may well start a move down to the declining purple lower trend line, currently at 584 of the old descending triangle. End of quote. Well, last week prices dropped and closed below all of these, and this week we are playing with that declining purple lower trend line and the July 2021 low at 578, and we're looking possibly to make a daily key reversal down today. I asked a question last week whether this support will hold or not. Here is my answer, and I quote, right now I personally think this purple trend line is not a line in the sand, but rather the start of layered support stretching from about 590 down to somewhere between the March 2021 low at 559 and the March this year low at 551. So from 590 down to 559. I continue quoting, so I would watch out for a possible slowing, even a halt under the purple trend line. Now, despite the activity today, that is what the market has given us, and that is what we have received. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Toftvik and ADM Investor Service International Limited. And here comes the final important bit.